Why the U.S. doesn't have the stomach or the strategy for a full-blown trade war with East Asia. This is by NGG. The Trump administration has finally put some teeth into its America First rhetoric, imposing tariffs on big washing machines from South Korea and solar panels from China. A hefty tariff on Chinese steel is being floated, while Chinese aluminum is rumored to be on the chopping block. At Davos, the U.S. Treasury Secretary was talking down an already weak dollar. Are we seeing the start of a long-feared trade war between the U.S. and East Asia, especially China? I suspect this is not a real trade war. The Trump administration doesn't have a strategy to go all the way. The U.S. economy depends on a vast stock market bubble and foreign financing of its fiscal deficit. Its tax cut is adding $1.5 trillion to its deficit over the next decade, making it more dependent on foreign capital. If the U.S. goes deep into a trade war or debasing the dollar, the stock market will crash, foreign money will flee, and its bond yield will surge, and its economy will crash. A credible trade war requires two elements: the U.S. being prepared for a prolonged recession and a coherent industrial policy. The U.S. economy is driven by maximizing short-term profitability for big listed companies. They have been driving the outsourcing model in global trade because cutting costs through outsourcing is the quickest way to boost profit. The high stock prices from the boosted earnings reward the top managers at these companies. The U.S. CEOs have seen incredible increases in their incomes, far ahead of their counterparts in Germany and Japan, while its industrial workers face declining wages. Unless the U.S. changes the incentive structure for its top corporate managers, this dynamic won't change. Germany and Japan, while they don't publicly admit it, have industrial policies. They concentrate resources in industries where they could achieve long-term competitiveness. Their CEOs put the country's interest ahead of short-term profitability. And they don't pay themselves tens of millions of dollars because their societies have implicit social contracts against it. They are still high-cost countries and can't achieve high economic growth, but a deep industrial base leads to a more stable and equitable economy. The ongoing trade dispute with China continues the decades-long pattern in how the U.S. handles its trade with the East. 4 decades ago, the anti-Japan rhetoric was more heated than that against China. Far more serious restrictions were imposed on Japanese steel, automobiles, and electronic products. They have had no impact on how industrial development has evolved on both sides. What has changed is that the industries have moved from one Asian country to another. East Asia's advantage in manufacturing is not just labor costs. Its labor quality is superior to that of the U.S. Even more important is cheap capital. East Asia has a high savings rate and accounts for most of the net savings in the world. Any capital-intensive industry is likely to be rooted there. An industry such as semiconductors may start in the U.S. but eventually become a typical East Asian industry because it is capital-intensive. This advantage in capital may be exaggerated by financial repression that boosts savings. Countries like China should eliminate financial repression. Still, even when government policy doesn't tilt the savings rate one way or another, East Asia will likely have higher savings rates. Anglo-Saxon economies like the U.S., Britain, and Australia practice the opposite of financial repression. Their financial markets tend to exaggerate paper wealth and encourage borrowing. Hence, they have an unusually low savings rate and a high cost of capital. This is a key reason that Germany and Japan have stronger industries. If the U.S. wants to reindustrialize, it must first stop excessive money stimulus that encourages debt. From made in China to created in China, U.S. President Trump's protectionist policy will at best prolong the life of sunset industries like steel and aluminum. As the capital market sees their high costs, it will hold back and they will just wither away. For an industry like solar panels, it will merely encourage tariff arbitrage. Some companies will start local assembly operations with imported components, mostly from China, similar to what developing countries used to do. A real trade war could occur only if the U.S. asset bubble burst and the Federal Reserve cannot start a new one. That would mean a prolonged recession. The nascent populist movement that got Trump elected will become a dominant force and completely change the country's ruling elite. That is a possibility, but not likely, at least in the next decade. The first bubbles over the past 3 decades have created a powerful and extremely wealthy class. It is difficult to see that they will give up easily and their wealth deflate under a new regime. The U.S. will stick to the whack-a-mole approach in its protectionist policy. This may scare other parties into doing a few things to boost U.S. exports, but the big picture won't change. The U.S. will continue to run large trade deficit until East Asian countries don't want dollars anymore. When that day comes, the dollar will collapse and the U.S. will slide into stagflation, while East Asian companies will be stuck with deflation. A better way to challenge China on trade. Trump's harmful tariffs aren't the answer. President Donald Trump has finally delivered on a premier campaign promise to hold China to account for its unfair trade practices. The president deserves credit for being more willing than his predecessors to call out China's bad behavior, but his remedies are among his most disruptive and isolating foreign policies yet. Wide-ranging tariffs will harm American companies and consumers, punish their U.S. allies, and undermine the system. There's a better way to challenge China that protects U.S. innovation and sustains both U.S. prosperity and leadership in the international economy. There's no disputing that China has done damage to the global trading system and U.S. economic interests. For years, Beijing has flooded world markets with subsidized goods, forced U.S. companies to transfer proprietary technologies to Chinese firms, restricted foreign access to broad sectors of Chinese economy, and engaged the outright theft of intellectual property. The United States has paid a heavy price and lost growth and jobs. Now, as China moves up the value chain, these same practices are threatening the U.S. prized innovation base as Beijing aims to dominate the technologies of the future, including robotics, health sciences, and artificial intelligence. America first, America alone. Trump's desire to combat China's mercantilism is widely shared across the U.S. political spectrum and increasingly in the U.S. private sector. The more controversial is his approach. The Trump administration has employed a series of rarely used domestic laws that predate the multilateral dispute mechanisms of the World Trade Organization, specifically provisions in the Trade Expansion Act of 1962 and the Trade Act of 1974 that allow the U.S. government to respond to a range of dangers to national well-being, including surges of imports, over-dependencies that threaten national security, and discrimination against U.S. firms. Trump has decided to use these laws to impose sweeping tariffs on imported washing machines and solar panels, then on foreign steel and aluminum, and now in his March 22nd announcement against at least $50 billion worth of Chinese imports per year for technology-related abuses. Trump's tariffs may succeed in the narrowest sense of redressing some of China's harmful practices in the short term, but the damage done in the process will greatly outweigh the benefits. With few exceptions, economists agree that tariffs are a lousy tool. They raise prices for consumers as well as downstream companies that rely on foreign inputs. Trump's tariffs on steel, for example, were arguably good for the U.S. steel industry, but terrible for a whole host of U.S. manufacturers. By some estimates, tens of thousands of job increases from Trump's steel and aluminum tariffs will be offset by nearly 500,000 job losses throughout the U.S. economy, meaning roughly 18 jobs lost for every one gained. This isn't just theory. Steel tariffs levied by President George W. Bush in 2002 cost an estimated 200,000 jobs. If that wasn't enough, Trump's tariffs could have major knock-on effects on the broader global trading system Other countries are likely to follow Trump's lead, using an expansive definition of national security as an excuse to put up all sorts of trade barriers that lock out U.S. companies. Affected countries are also likely to take the United States to the WTO on grounds that the Trump administration's national security exemption lacks merit. The expansive nature of Trump's initial decision on steel and aluminum tariffs also impedes efforts to mount an effective coalition of countries to counter China's trade practices. By covering all trading partners, including key allies in Europe and Asia, the initial announcement sent exactly the wrong signal to partners such as Australia, Japan, Germany, who should be working with the United States to deal with China's overcapacity and intellectual property theft. It led the European Commission to go as far as openly talking about retaliation against U.S. goods, such as blue jeans and cranberries, and South Korea's foreign minister to imply a less cooperative stance on the North Korean nuclear crisis. The Trump administration finally yielded to this pressure and exempted these and a number of other trading partners from tariffs. But key allies such as Japan remained on the target list, and the broader political damage was done. Tough but targeted. Trump's wrecking ball approach to trade is not the only alternative, nor should the default be a return to fruitless dialogues and endless negotiations. Instead, a healthy combination of strong political will in Washington and in American leadership abroad can parry China's unfair advantages without doing significant collateral damage in the process. The best offense starts with good defense. The United States should update and bolster the Committee on Foreign Investment in the United States, the government body tasked with examining foreign investments for national security concerns. Already, there is bipartisan legislation making its way through Congress to tighten screening for critical technologies. It will be crucial for Congress to do this in a way that avoids doing broader damage to the open U.S. investment climate, and provides the CFIUS sufficient resources to handle a much larger caseload. Similarly, more staff and resources at the Office of the U.S. Trade and Representative would allow greater focus on trade enforcement in addition to negotiating and renegotiating trade agreements. Trade remedies are a legitimate part of any response to the China challenge. The Trump administration is not wrong to look to tools such as Section 301 of the Trade Act of 1974 to brush back Chinese bad behavior, including forced technology transfer. But actions taken under U.S. trade laws should root out underlying problems, win the support of other trading partners, and avoid violating Washington's international obligations. But contrast, raising tariffs will almost certainly violate WTO rules and invite damaging retaliation. With a more targeted approach to China, the United States could better rally key partners to address malicious Chinese practices in a more coordinated fashion. U.S. actions alone will do little if China can simply go to the next highest bidder. Washington should be working with Asian and European partners to file WTO cases and share information about China's investment activities. In addition to playing good defense, the United States should also lead with positive vision by writing a new trade and investment rules for the 21st century. This holds the best promise for curbing China's unfair practices over time by requiring Beijing to play by the rules if it wants to continue benefiting from open trade and investment with the Asian Pacific and beyond. This was precisely the purpose of the Trans-Pacific Partnership and the Transatlantic Trade and Investment Partnership agreements, both abandoned by Trump, which would have set high standards and rules for many issues of concern related to China, including on state-owned enterprises, government procurement, and data localization. The deals also included labor and environmental standards to level the playing field for American workers and prevent a race to the bottom. Trump's decision to withdraw from the deal is estimated to cost the United States potential income gains upward of $131 billion by 2030, annually by 2030. Not to mention that the subsequent negotiations without the United States have led to the suspension of more than 20 hard-fought-for provisions on intellectual property and other disciplines. There's an old saying
If goods can't cross borders, soldiers will. So the matter of a trade war, or something that starts off as a trade war, a major trade war, can and does have a high probability of turning into a shooting war. And I think the only reason it hasn't is because of nuclear weapons. But is there a point when a nation or even a civilization's economics is challenged or threatened? Economic war can turn into a shooting war. Will the United States accept its place as a declining power? Or will it continue to go through its death spiral, death throes, and possibly taking out the whole planet with it? I do still believe the adults are at the table, and I do think this trade war, which is still relatively minor, will get worked out. I don't believe the United States or even China has the stomach to take on the displeasure of its people or the problems of its people if a trade war actually heats up and actually goes into critical phases. Now, the Chinese economy is the stronger of the two. And since China still has memory of its recessions, of its troubles, of even its starvation, where the U.S. does not, their people may be more resistant and resilient against severe economic downturns. Now, there's other assets that I will actually bring in probably either later on this week or possibly next week, where we'll focus on this tariff war, this trade war, this financial arms race that we're in the middle of, because it doesn't just go with finance. It's also industry, where we're going through the development of technology, AI, Bitcoin, not Bitcoin, but cryptocurrencies, self-driving automobiles, robots, that kind of stuff. That's all economic, and it's an economic race. It is United States trying to save itself. Even Donald Trump is trying to isolate the United States from the rest of the world to try to save its patient. I do believe Donald Trump is trying to put the United States into a protective coma, such as you do with a patient that is severely injured or severely sick. What you try to do is isolate them by putting it into a coma. Is Donald Trump trying to put the United States economy into a coma? That remains to be seen. Harsh tariffs do exactly that. It isolates a country from the rest of the world and makes the economy or the trade severely restricted, and will throw large parts of the economy into a depression. Anytime you have tariffs, you throw the country into a severe recession. Like I said, it was in the 70s and parts of the 80s. Devaluing the dollar, as has been done before, to actually fire up exports may not work because China can do it far better than we can. But like I say, that's another thing that remains to be seen. May we live in interesting times. But this is just the first part in probably an ongoing series about the United States and China going through its continuing, because it started 20 years ago, economic strife between the two. But with that, I'm going to jump off of here. This is BGS out, and may you all live in interesting times. Peace.